Cash. It's owned by some don't. A few people are experts at it. The majority are still after it. You could believe that money is merely made up of numbers, spreadsheets, and maths, or a formula that requires resolution. However, the actual financial decisions are made around dinner tables, distant from calculators, with consideration for one's own ego, pride, fear, and past experiences. The dance between human nature and the calculating coldness of a spreadsheet is the fundamental essence of money. We are complex beings when it comes to money, and being financially successful has less to do with knowledge and more to do with behavior. Let's explore the peculiar and human side of money. Morgan Housel's fantastic book, The Psychology of Money, served as the inspiration for this film. Our financial DNA varies greatly because we are all from different generations, have parents who have different incomes and values, live in different parts of the world, were born into different economic environments with different opportunities and incentives, and have experienced money in very different ways. Consider inflation in the stock market. For instance, the S&P 500 increased by over 10 times for those born in 1970. And as a result, most of them had a favorable opinion of the stock market and were more likely to invest. Individuals born in 1950 saw a stagnant stock market during their adolescence and early adulthood, which shaped their perception of the market and reduced their propensity to invest. People who were born in the 1960s saw a lot of inflation in their teens and 20s, which increased their awareness of the phenomenon and made them more skeptical of its impacts. Individuals who were born in 1990 have not been as concerned or conscious of the consequences of inflation as those who were born in earlier generations. A person's attitudes and behaviors towards investment and financial decision-making are significantly influenced by their early experiences with the stock market and inflation. Individuals use their mental model of the world, which they inherited from their parents and is modified by their own life experiences, as well as the information available to them at the time, to explain every financial decision they make. Even if they might be uneducated, ignorant, or make poor choices, their actions make sense to them at the time and fit their own unique narrative. People do some crazy things with money, claims Housel. However, none of us are insane as we all have different worldviews. And there isn't a one effective method for handling money. We make financial decisions based on our worldview and personal life experiences. Compound King's Warren Buffett is without a doubt regarded as one of the best investors of all time. Buffett was able to leverage the power of compounding since he began investing at the age of 10. Housel notes that few pay enough attention to the simplest fact. Buffett's fortune isn't due to just being a good investor, but being a good investor since he was literally a child. Assume you make a $1,000 investment with an 8% interest rate. After a year, your initial investment would have yielded $80. You would now earn $86.4 if you compounded your $1,080 total at 8% interest the next year. This means you have profited from both your initial investment and the income you received on the principal. Compounding an investment over time results in interest from both the initial investment and the interest that accrues over time. Because compounding is counterintuitive, many of us are unaware of how severe the effects might be. On the other hand, compounding can eventually enable you to make more money. By the age of 30, Warren Buffett had amassed a $1 million net worth, having started investing seriously at the age of 10. In a different world, perhaps, Warren Buffett would have behaved more like most young men in their 20s and spent a large portion of his early wealth on luxury vehicles and travel. He would have had a net worth of about $11.9 million today. If he had begun with a net worth of $25,000 at the age of 30 and retired at the age of 60, all while producing the incredible average returns of 22% yearly. The foundation of wealth that Warren Buffett established in his early years and his longevity as an investor are the main factors in his success. Although he is skilled in investing, time and the compounding effect are the keys to his success. Think about things from an alternative angle. Warren Buffett is the richest investor of all time. Nonetheless, he is not the best in terms of average returns. For example, since 1988, hedge fund manager Jim Simons has compounded money at an astounding rate of 66% each year, far greater than Buffett's rate. However, Simons' net wealth is only $21 billion, 75% less than Buffett's. How is it possible? Housel claims that the reason for this is that Simons had to wait until he was 50 years old to really start making investments, essentially allowing him to compound over fewer years than Buffett. Housel calculates that his current net worth would be if he had made investments over the same length of time as Buffett. The power of compounding is enormous. 63 quintillion 900 quadrillion 781 trillion 780 billion 748 million $160,000. Compounding produces findings that, despite their seeming counterintuitiveness, should never be disregarded. Dim-witter and finances. Though we all harbor a deep-seated tendency towards pessimism, when it comes to money, optimism is the conviction that in the long run, the odds are on your side, even in the face of adversity. But looking back, things have become better over time in general. What therefore makes us more likely to accept pessimism than optimism? The reason is that good things don't happen instantly. They take time. Pessimism is drawn to the topic of money for a number of reasons. First of all, money is important to each and every one of us. We are more likely to pay attentively when we learn about negative economic news. For instance, a 40% drop in the stock market over a 6-month period is likely to draw notice right away and possibly lead to government action. Nonetheless, it may be difficult to see how a 140% increase spread over 6 years is incremental. Over the past 50 years, medical advancements have saved the lives of 500,000 Americans annually. On the other hand, rapid, unexpected losses like terrorism, plane crashes, and natural disasters garner more attention than slow development. Overnight miracles are rare, but overnight catastrophes are often. We don't have to be gloomy in order to be realistic. Even in the face of failure, we can cling to the hope that eventually things will work out well for us. When you see headlines about a stock market meltdown, economic distress, or other financial issues, try to keep in mind that things usually get better with time. There were 300 pupils enrolled in Lakeside, a tiny school in Seattle, out of the approximately 300 million individuals in the world who were of high school age in 1968. At the time, Lakeside was the only high school globally where a professor had the vision to rent a computer, specifically the Teletype Model 30. This was not your typical computer. Even graduate students didn't have access to such a sophisticated device at the time. And this would completely transform the life of one fortunate Lakeside student. Bill Gates was that pupil, 300 million down to 300. The likelihood of having access to a computer as a high school student in 1968 was essentially 1 in a million. Together, Bill Gates and Paul Allen, a classmate, would start Microsoft. Gates demonstrated extraordinary intelligence, diligence, and a unique vision for computers even as a youngster. However, attending Lakeside also provided him with a unique competitive edge and early benefit. In 2005, Gates boldly declared, "If there had been no Lakeside, there would have been no Microsoft." However, a third member of this group of high school computer whiz kids is rarely acknowledged in the early Microsoft narrative. Evans Kent, equivalent in both intelligence and vision. Together with Gates and Allen, Kent may have been one of the founding members of Microsoft, but that would never occur. Kent was killed in a mountaineering accident prior to receiving his high school diploma. A high school student's chances of dying in a mountaineering mishap are approximately 1 in a million. Similar to how Paul Allen and Bill Gates would achieve immense success, thanks to an exceptionally uncommon bit of luck, risk. The close brother of luck that Housel refers to as chance would present itself to Kent Evans in the form of an incredibly rare event, like the wind and waves that dictate a sailboat's path. Luck and danger play a similar role. Although the sailor has control over the sails and rudder, in the end, the boat's direction and speed are determined by outside forces that are uncontrollable and unpredictable. The journey towards achievement is rife with detours, and it's crucial to remember how fate and chance impact our lives. Knowing that success is a complicated mix of elements, involving both skill and luck, can make us more humble and objective while making our own financial decisions. The secret of contentment. The pursuit of material wealth has led to many people working harder and giving up more control over their time, even though they are richer than ever before. According to Housel, the key to happiness is the ability to do what you want, when you want, with who you want, for as long as you want. People want to become wealthier in order to be happier. More than your income, home size, or professional status, research indicates that having control over your life is the most reliable indicator of positive feelings of well-being. The greatest return on investment is ultimately time management. Seeking financial gain at the expense of time is akin to trying to fill a bucket that has a leak. Water will leak out regardless of how much you pump in. Similar to this, having control over your time and being able to enjoy the results of your labor are prerequisites for permanent happiness, regardless of how much money you amass. Tail events that propelled its rise. All of Amazon's less successful ventures, like the Fire Phone or travel agencies, were more than offset by these two products. Rather of offering an apology to shareholders following the disastrous launch of the Amazon Fire Phone, Jeff Bezos stated, "If you think that's a big failure, we're working on much bigger failures right now. I'm not joking." Bezos recognizes that it is acceptable to make errors and fail with the majority of goods as long as the process results in the 1% of tail event products that drive everything. Some of them will make the Fire Phone appear like a tiny little blip, because we only see the final products and not all the mistakes that went into making them. Tail events are typically counterintuitive and concealed from us. In the book, Housel gives an example of a stand-up comic from real life. You find yourself thinking, "Wow, this comedian is amazing," while you watch the Netflix special. What you don't see are all the unsuccessful jokes that the comedian tested out in small venues across the nation in preparation for the special. The Netflix special is a 1% compilation of all the jokes from tail events that had people laughing. 99% of the jokes were probably just passable. Even while lengthy tales are common in investing, most of us choose to overlook them. We have a tendency to overreact when things go wrong. You quickly come to the realization that many things in business, investing, and finance could go wrong, fail, or collapse once you acknowledge that tails drive everything. Recall that only 10 of the almost 500 stocks that Warren Buffett has chosen have generated the majority of his wealth. Good stock pickers will only make 50% of their decisions correctly. Only 50% of the time will wise decisions be made by good leaders. It doesn't follow that things won't work out in the long run just because you could occasionally be mistaken. At the end of the day, very few occurrences will determine the result. Real wealth versus being rich. It's critical to recognize the distinction between the two. Richness refers to your present income and possessions, whereas wealth refers to your financial assets that you have not yet depleted. What you don't see is more valuable than what you can see. Although it's simple to assume that someone who drives a Lamborghini is wealthy, looks can be misleading. In actuality, a lot of people live beyond their means and depend on debt to pay for their ostentatious lifestyles. The financial assets you have yet to spend are what define wealth, not the mansions you possess, the vehicles you drive, or the diamond rings you wear. It takes discipline and self-control to accumulate wealth. The watches, diamonds, and first-class upgrades you turn down all add to your total wealth. Rich people who spend extravagantly are simple to identify, but real riches is more elusive and hence more difficult to emulate. Although it is ingrained in our minds that owning money entails spending it, saving, and investing, your existing funds is actually the key to accumulating wealth. As a matter of fact, the only path to prosperity is to hoard the money you already have. Remind yourself the next time you see someone living in a large home or driving a luxury automobile that you can't determine their level of wealth just by looking at them. The real secrets of riches are saving money, being disciplined, accumulating assets, and making future investments, the real price. Visualize yourself ascending a mountain in order to reach the summit and take in the breathtaking scenery. That day, it might rain or it might be sunny. It's possible to become lost, to fall and hurt yourself. And sometimes the difficulty of the climb isn't obvious until you're right in the middle of things, while the route may appear clear. When looking up from the ground, you will undoubtedly need to stop along the way and adjust your course in order to reach the summit. You do not, however, believe that there will be a golden escalator that will transport you to the summit in safety. Prior to the climb, you are aware that this level of risk and uncertainty is simply the cost you must bear in order to reach the summit. However, a lot of individuals believe they can obtain something for free and avoid risk and uncertainty when it comes to stock market trading. Husserl compares purchasing a new car to the stock market. There are 3 ways that you can purchase an automobile. An automobile can be stolen, purchased new, or purchased used. Although the cost of the new car is higher, the benefits are more. Consider purchasing a new car similarly to trying to get 12% stock market returns. Even though a used car only yields 4% annual profits, it is a far safer investment. Attempting to obtain something for nothing is analogous to car theft, since the risks of stealing the car outweigh the rewards. 99% of people would refrain from doing so. But when it comes to the stock market, it appears that many believe they can choose option 3 and profit from the market. To gain strong market returns without having to pay the price, they experiment with a variety of ruses and tactics, attempting to purchase or sell just before a market upswing or dip. For instance, let's say you wish to save for retirement by earning an 11% yearly return over a 30-year period. The Dow Jones Industrial Average has returned almost 11% year between 1950 and 2019. Nonetheless, there were undoubtedly a lot of great points and terrible points during those 69 years. Many people find it upsetting to watch their investments fluctuate, so they attempt to make rapid exits without incurring long-term instability and uncertainty. It's like trying to steal a car. When investing, there's more to the cost than simply money. You also have to pay for the emotional toll that risk, volatility, and terror may take. Understanding that profitable investing has a cost is essential. You must pay this amount, just like you would for any other goods, even though it is not immediately apparent. The trick is to persuade yourself that paying the market's cost is worthwhile, that it's like paying an admission price. You won't enjoy the event if you view the admittance charge as a fine, but there's no guarantee that it will be. As soon as you locate it, be prepared to pay the price. When enough is enough, hedonic treadmills, enough, are aware of it. Learn about the hedonic treadmill, also known as hedonic adaptation. You keep advancing the goalposts after each goal that you score. All you have to do is consider the fall from Grace of Gupta and Bernie Madoff, two extraordinarily wealthy and well-equipped guys. But even with all the money in the world, they would have needed more, and they would have turned to crime to get it. Without a sense of when enough is enough, pursuing wealth and success is like trying to climb an endless ladder. There is always another rung to aim for, no matter how high one climbs, and the quest can become all-consuming, resulting in a lack of fulfillment and contentment. And if you found value in today's video, don't forget to like, subscribe, and hit that notification bell so you never miss out on the latest financial tips. Your financial empowerment starts now. Let's build a brighter, wealthier future together. Until next time, stay financially savvy.